On today's show, we're talking Fed meeting and interest rates, 2026 contribution limits, and rebalancing a portfolio. Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Yeah, you are.
Welcome back, you guys.
Feels good. Yeah. Taylor and I have been out for a while for different reasons.
Yep.
Yeah,
But,
I don't know if I can agree with the feels good part, but
It doesn't feel good to be back?
well, it feels good to be back, but do I feel good myself? No, I do not. I
Yeah.
feel-
Tell us why, Taylor.
Well, as you guys know, everyone's paying attention to Matt and I's personal lives. And our
Everyone's
updates.
following our life, obviously.
100%. No, Shelby and I, we welcomed our 4th child on January 10th to our
Heck
family.
yes.
But we happened to time it perfectly with both sets of our parents being out of the country. So the paternity leave that I've had over the last 2 weeks has been unlike all of my previous paternity leaves where I had help from mothers and mother-in-laws and family. And it was just on me to take
The
care
real
of the other
test.
3 kids, plus my wife and newborn baby. And I think my kids were just as ready for me to go back to work as I was. So
They're like, get this guy out, get the substitute teacher out of here. We're ready for the real thing. We're glad to have you back.
Yep.
Give us the deets. Jameson.
Jameson McKay Sutterfield, 8 pounds, 7 ounces. So he had a weird head thing going on for the first couple of weeks, but that's since resolved. So, baby's healthy.
How much do you
happy.
want to go into the pressure that Shelby was feeling? Like, what would you have done if it was a girl, Taylor? Let's talk about that for a second.
We just would have given it back,
Yeah.
Accepted it.
You'd have returned. What's the return policy on this thing? No, there's been an internal joke here at DA that Taylor was really wanting a boy, and his wish was granted. I don't know how you guys wait till the reveal the day of. That's a lot. I've never been able to do that.
Well, that's the thing is I've always wanted to do it, and Shelby would never let me do it until we had one of each. So we had 2 girls and then we had a boy. And so this was the first chance that we had to find out the gender or not be surprised on the gender. And if I could do it again, I would not do it on the 4th, right? Because if you really want a particular
Neither
gender,
would Shelby.
right? And I wanted it, Shelby wanted it. We just like the idea of 2 and 2 and having a sibling, same gender sibling for everybody. And so we just put this undue pressure on gosh, this would be amazing if it were a boy. And if it's a girl, that's still great, but we want it to be a boy,
Robbie's just rolling his eyes.
And the closer it got, the more this pressure built up to the point that I was joking with Matt, the week before I went on paternity, I was saying if this isn't a boy, I'm just going to be disappointed. It's got to be a girl. And then Shelby texted me as I'm talking.
While we're talking.
And she says, I've been crying all day. I feel like if this isn't a boy, I'm going to let you down. Meanwhile, I'm this has nothing to do with Shelby.
Nothing.
She biologically has no say on what the baby is. It's all my fault to whatever this gender ends up being. So, I'm just again, what women go through with their bodies and hormones through pregnancy, it's incredible, right? Not to make light of anything, but I'm just Shelby, what are we doing here? We're going to love this baby regardless.
Yeah.
But
everything she goes through, and then you just had to put a little extra pressure on her. No big deal.
She was doing it to herself. She wanted the boy just as badly.
Yeah. Well, we're glad it all worked out. More than anything, we're glad that baby and mom are healthy.
Yeah.
And that your kids got their wish of you going back to work.
Yeah. So I'm back to work, and my mother-in-law gets back on February 17th. So we're counting down to the
Who's
days.
counting? Yeah. Well, good to have you back. It's good to be back. I did not welcome a new baby into the world, but I was hanging out in the hospital for a while. So it's good to be back post-surgery. I've been looking forward to this. So let's jump in, Rabih. Fed meeting and interest rates. Let's give the update to the good people.
Yeah, Taylor had a baby. You had a new back. I got a new Fed meeting. We're all celebrating.
I welcomed a new back into the world. Yeah.
And I welcomed a new Fed meeting into my archives. On Wednesday, the Federal Reserve met and they did not cut interest rates. And it seems like there were two camps. There is the camp of noise and there is the camp of, let's be rational over here. So the Federal Reserve decided not to cut interest rates because, and I quote them, the economy has entered 2026 on a firm footing. The economy is doing much better than we think. And
I feel like that's just a theme, Rabih. I feel like every time we do this, that's the theme.
And it's because of spending. And it's because the Americans are spending. But to be more specific, it's because the top 20% of Americans are spending so much that they are overwhelming the bottom 80% that is actually not doing as well. So the economy is doing, from a spending perspective and from a business investment perspective, it has very strong numbers. The only thing that is weak in those two sections is real estate, and they mentioned it. The Fed is saying the economy is entering on a strong footing. We believe the unemployment rate has stabilized. Remember, it was like at the low fours at one point, like 3.94, and then went up to 4.4, 4.5, 4.6, and it's like fluctuating in that range. So it's stabilizing around 4.5. So in their perspective, it's like economy growing strong, unemployment stabilized, and inflation is still around actually PCE for the last 12 months, core PCE ended at 3%. That is the number they want to bring down to 2%. And I honestly, more of a hypothesis in my mind, maybe the difference between 2% PCE inflation and core PCE inflation and 3% PCE inflation is what is causing this K-shaped economy, where the lower income or lower 80% of the US, 3% inflation is hurting them, whereas the top 20%, 3% inflation is not hurting them. Maybe at 4, they'll feel the hurt. And that way, there is a big diversion in what we're seeing. And it also explains why the sentiment is down, but people are still spending. All of that together, right? So this was what the Fed said. They said job gains are remaining low, but non-farm payroll, aka new jobs being created, is also declining, and private payroll rose. So less people are getting hired and less people are getting fired, but the people who are in their workforce are all getting raises and they are making more money. So unemployment, weak labor market, it's not budging, but everyone who's still employed is doing well. This is their view on what the economy is.
And so job gains remained low, but
private payroll rose.
When unemployment is still low, though.
Yes.
So it's like static. No one's getting fired, really, but just not as many people are. There's not a lot of jobs available right now.
Yes.
Got it.
No jobs being created.
Incomes are going up.
100%. Exactly what's happening. And they said, their outlook for economic activity has greatly improved. And then this press conference started, and it was so boring because they were talking about, are we in the upper range of a neutral or in the middle range of neutral? So it's just to see how much of the Kool-Aid the market has drank, and they're following onto the decimals. At this point, I'm like, okay, guys, let's see the bigger image. And the big picture was you either follow what the Federal Reserve is talking about. It's we focus on a strong economy, a stable unemployment rate, inflation that is still higher than target, but is trending in the right direction. And we noticed that now there's a gap between a stronger GDP, but the weakening labor market, and the gap between them, because if the labor market is weakening, as we're noticing, no new people are getting employed, etc., it usually means the GDP is also weak. But there's this diversion between them. You can't have one than the other. And they think the gap that fills that dichotomy is that we have more productivity gain. We're more productive than we've ever been. So you do not need as many people as you used to keep the economy growing so fast and so well. This could be because of AI. This could be because of the shift in work-life balance post-COVID, all these different factors are keeping the economy really well, doing really well, without having to put a lot of people employed. This is where we are. But then you got the noise part of the story. And the noise part of the story were continuous questions about what is happening with the US dollar as a currency. Why is it going down? What is happening with the Fed chair drama? Like, there's a court case against Jerome Powell. The case with Lisa Cook went to the Supreme Court. We're wondering on whether Powell is going to stay or leave, and like who Trump assigns as the Federal Reserve Chair. Like, there's all of this noise out there.
Breaking news
this morning. So there are two camps. Like, you choose what you want to focus on. You could either focus on economic growth, which are amazing numbers, unemployment, which is stable, inflation that is trending in the right direction, and move on with life. Or you tune to all the other stuff and think that the fact someone is going to court, it means that the US economy is going to crumble, right? You choose your camp, but this is where we stand. And it seems like no interest rate cuts, because the economy is doing well. Once the economy starts weakening, we'll see interest rate cuts.
Rabih, really quick, you and I talked yesterday or Wednesday. We had done a show before the end of the year where the Fed had made some projections on. I just want to point this out because we talked about it. I think this is kind of the epitome of navigating the noise, right? Mm-hmm. Because they had talked about GDP being average annualizing at 1.7 after Q4. So then you were like, wait, that means they're thinking it's going to go negative in Q4.
Yep.
Where do the numbers actually end up that led to them keeping interest rates static?
Okay, so far till now, like GDP Q4 wasn't released, but there are models that tell us like where we expect it to be. As of now, as of January 29th, we expect the print on an annualized term for Q4 to be 2.9 growth, right? So for the economy to finish at in 2025 to finish at 1.7, given that Q2 was really good, Q3 was really good, you would have expected Q4 to be 0 or negative 0.1 for the average to be 1.7. Well, you don't have a 0, you have a 2.9, almost a 3, right? So if you add a 3 and you have two previous quarters that are also in the high 3s, low 4s, then you're going to end the year in the top 2s, low 3s for the year. That is double what they were expecting for economic growth. So, I do not know why they thought it is. And then actually they said government shutdown that happened back in November, October, delayed economic activity. So we expect Q1, which is now what we're living in, to even be higher growth, simply because it's compensating for the shutdown that happened in Q4. So it's growth upon growth upon growth, but there might be a partial Senate government shutdown because of the Senate as of tomorrow. Or Saturday when you listen to this. So this is still unfolding. But yes, like the feeling I'm getting, if you forget about trade and tariffs and you forget about government and whom they're firing and whom they're hiring and how much they're spending money, and you just focus on business activity and consumer spending, the economy is in really great shape. And honestly, you do not care about the government unless there's a crisis to bail everyone out. So just like forget about that for a while and focus on what really drives the economy. And that is in a very good shape.
Yeah. Let's get Taylor in here. I know you wanted to, the one thing you mentioned as you're putting these notes together, Rabih, that we didn't have a new Fed chair, but as of this morning, we do. And Taylor's done some robust research and is feeling great about him. I heard.
Yeah, that's exactly my thoughts. No, I mean, before we do these 2 cents episodes, we always come with a topic that's interesting to us. And so I had been researching about interest rates and mortgage interest rates. And just because a lot of clients are sitting on debt that they could potentially refinance, but they hear it's going to drop. They're like, should I refinance? Should I wait 6 months? So there's a lot of this like wait and see happening with clients right now. And so I was curious and I was reading a couple articles about mortgage rates, and this group was basically projecting out mortgage rates because they're based off the 10-year Treasury note and figuring out what that would look like. And they were using AI and different forecasts. And the conclusion that was made was, hey, these rates could go down, but not a lot. In almost every single scenario, there wasn't a single scenario where we were seeing in the next 5 years 3% interest rates coming back, right? So like
we may never see those again.
Yeah. That's what a lot of us are anchored to, right? We're just anchored to that 3% interest rate. And so we hear hey, there's going to be a new Fed chair. Trump's going to appoint someone. He's favorable to rates dropping. And so we think rates dropping means we're getting to 3 again. And by all metrics, it was saying like, that's just not happening, right? In most situations, we could see this go to like 6.2 on a 30-year mortgage, maybe get into the high fives, but 3 is kind of out of the ballpark. And then at the very end of the article, the huge exception said, barring significant changes in monetary policy, right? And then did all this, and then this morning we get the announcement of, a new chair has been appointed or is up for appointment. Right. And so my immediate thought, I did some basic research, but my immediate thought was, I need to talk to Rabih. Who is this guy? What's his take? Do we like this guy? What's his track record? And from everything I read on the surface, it was kind of scary because it was like, hey, Warsh has been working with the Fed in past regimes. He worked with Bush from 2007 to 2011. Which was like
solid years.
I don't know if I like that on my resume if we're talking about who's in the Fed. So I was curious. Again, I don't expect Rabih or Matt, you guys to have much background with this guy, but I was curious if you guys have any takes or have any immediate reactions to this new appointment.
Rabih does. I have zero.
I do a lot. So I'll speak on all of our on the behalf of all three of us. So the background about Warsh, as you mentioned, it's one of the Kevins, right? The betting market was saying it's either going to be Kevin Hassett, Kevin Warsh. And before we go into Kevin Warsh and what he did, I know we're used to this administration dropping like surprises on everyone. Not with this one, because it is too big of a topic and too important for financial markets to just wing it. So what happened is that they threw out the name for Kevin Hassett at the beginning, and the market reaction did not like it. And you see it through interest rates and how they price in expectations about interest rate cuts. And Hassett, actually, the first guy, is more of a Trump loyalist. There was fear about Fed independence as a part of it. And then they started throwing in Kevin Warsh's name around mid-December. So this is not new. The market was pricing in a good probability that Kevin Warsh would be the one assigned, and there was like a 65 to 70% favorability or a bet that Warsh will be assigned. And as of last night, it was like 95% that it's going, like even before the president assigned. So the betting markets kind of know ahead of time. And the fact that they threw out Hassett and they looked for the market reaction and they saw that it didn't really like, they withdrew and then threw in Warsh, in the closed circles, and then see how the market absorbed that piece of information. It kind of provided us with a sense of, comfort. Everything is going to be okay. So why did the market accept Warsh? One, as you mentioned, he has previous Federal Reserve experience. He was one of the voting members on the board between 2007 and 2011 when the great financial crisis happened. But something about Warsh is that he is Republican. He belongs to the Republican Party, but he is not as controversial as Hassett, and he might stand up for Fed independence and raise that banner really well, which is what the market wanted. Something else that happened when Warsh was on the board of the Federal Reserve and they were doing quantitative easing. Like, remember those back days? We had TARP show up, which is a program by the Treasury to finance and create liquidity in the markets. And then they wanted to do more than one batch of having the Federal Reserve go out and buy bonds. He was critical of it. So that guy is not really as dovish. Warsh, his record does not say that he's highly favorable of low interest rates the whole time. This is what's interesting about it. This is a guy who was critical of having interest rates stuck at 0 for 15 years. He was critical of it. But where it's going to be interesting, I think, it's not going to be related to monetary policy. He's going to do what is preferred to the job. This is at least what the market expects. But what we think is going to be interesting and where the flavors of the Trump administration will show up in the new Fed is that he thinks like the Fed needs a regime change. It's going to be HR changes. It's going to be communication changes. Like, we know that this current Federal Reserve is highly data dependent, and they're all about open communication and telling you what they think and portraying and projecting their expectations ahead of time. Will that remain with the new Fed committee, right? If not, how will the market deal with the fact that they're not sharing as much information with us as they'd like to. These are the stuff that we matter. In terms of market reaction as of today, well, if you're worrying about the Federal Reserve, you look at interest rates. And the 10-year interest rate did not move today at all, which means for them, it's business as usual that this guy now showed up.
Well, they also, to your point, already kind of knew.
Already
right?
knew.
Yeah,
and,
so it's already priced in.
And the 10-year interest rate hasn't moved for like more than 4 months. So for them, it's all business as usual. What we're seeing in other markets, whether it's gold, it's currency, whether it's equities, this is not related to the monetary policy of the US. It's related more to what's happening around the world than it is what's happening to the US.
Got it.
So this is my take, Taylor, if you really wanted.
You don't seem as worried about his 4-year stint.
I'm not worried.
During the great financial crisis.
Well, this is why we come to Rabih, because we read things and we react, and we need to know, let's put this in context. No, I think that was really helpful. So, I mean, if I were to ask you guys, do we think there's going to be some significant rate change and interest rate drop under this new regime?
No.
We don't know, but what would your immediate take be?
There will be a political, probably quarter basis point, half basis point, just for the politics. It's like, I got a new guy in and he's lowering interest rates and, to heck with Powell, etc. Like that type of fiasco, the theatrics. But given that Warsh is more, is a bigger proponent of financial independence than the other options that are out there, I think the Fed will just cut interest rates when the economy needs it. And so far, the economy doesn't.
Yeah, I think Trump is a lot of hyperbole. He says a lot of things, as we all know. But I also think he realizes there's a line, and he's not going to take the risk of like truly like hindering that independence of the Fed. I don't think, because if that goes again, like I just think there's some disastrous consequences of doing that, and I think he knows that. So I'm with Rabih. I think there'll be some symbolic rate cuts that are already priced in, right, Rabih? I mean, they're already pricing in. They're saying static until mid-year.
Yeah, we're static till mid-year, and then we're pricing in a 1 or 2 cuts by December.
But probably 25 basis points each. Yeah, I think that's probably where it'll be.
So if you're sitting here listening as a dentist and you've got a mortgage or his practice loans or student loans or whatever, and you're kind of waiting for these to drop, best case scenario, we could expect maybe 1/4 to 0.5% tops.
Yeah. And listen, I mean, we talk about this a lot. I'm really glad you wrapped this in, Taylor, to the practicality for dentists. I would never make a financial decision in your personal life based on what may or may not happen with something that you can't control, like interest rates. Like I've heard this from people, like, I'm going to wait to buy a house until rates drop. It's like, that's so out of your control. It's like, you need to be focused on the things that you can control, your personal financial life. Does it fit with your cash flow? All that kind of stuff. I wouldn't be making any of those choices based on whether.
And I think there's that, and there's just a lot of people that are sitting on ARMs, right? 5 to 7 year ARMs for the last couple of years, and they're just waiting to see, when do I lock in my fixed 30-year.
Not to be the bearer of bad news, but if they cut interest rates, this does not mean that the 10-year will go down and mortgages will go down. The 10-year, which controls your mortgage, has a mind of its own. It's determined by the market. To give you a scenario, if, for example, the new Fed came in and the new Fed was like, oh, we're going to listen to every word the president says, and if he wants us to cut interest rate by 50, by 1%, whatever, we'll do it, the short end term will, like the 1 year, 3 months, etc., will drop by 3%. But then maybe the market will feel like this is reckless monetary policy, this will create inflation, and then the 10-year will go up. So there is a scenario where if they overcut interest rates and the market panics, your mortgage rate goes up, which is...
We've seen that. We've seen that. So...
It's called a bear steepener. So, in technical manners.
It's good. A good thought. I just don't. I don't think I'd be holding my breath on mortgage rates going anywhere right now. But that's a good point, Taylor, on the ARM. I've seen that as well. We have a lot of dentists over the last couple of years who have been doing more of the ARM type structure that need to be thoughtful about that strategy over the next couple of years for sure. Moving on, first of the year, we're no longer saying Happy New Year. Obviously, we're not weirdos, but we are still beginning of the year. and we think it's a good time to reference 2026 contribution limits. Taylor, you've mentioned this has been coming up quite a bit with your clients.
Yeah, it's just a common thing that comes up each year when there's a contribution change because, most of the time you're working with your payroll and 401k companies to figure out your contributions to your retirement plan, and then your financial advisor with your IRAs. And, you have things set up and you need to adjust things accordingly. And depending on payroll, are you weekly payroll, bi-weekly? Do you do bi-monthly? Depending on when you get the change, there's just a coordination that needs to happen, right? So I know we've been talking about this, but I don't know if we've talked about it on 2 cents. So I wanted to bring it up with Dennis, who listened here. The contribution limits have changed. My OCD brain is very frustrated with the change because
you and Jake are always on this.
It's so frustrating, but it was 23,500 in 2025, and I was just looking forward to it being 24,000 even, so that each month you could just do 2,000 and make it really simple and clean. But no, they decided to do 24,500. So it's very unclean, not a single dollar amount. So long story
We've written
short,
letters to our congressman about that change. We need just
make
divisible
divisible by 12. Just
by
make
12,
it
everything. Yeah.
Please do that. It makes my life so much easier.
Yeah.
Anyways, the contribution limit for 2026 went up by $1,000, right? For 401ks. For IRAs, it went up by $500. So it was $7,000. Now it's $7,500. But there's a couple.
Don't spend it all in one place.
Yeah. There's a couple changes that are unique this year compared to years past that I wanted to highlight because these are the biggest ones that are different. So if you are over the age of 50, there is a catch-up contribution. That is not different. But what is different? Last year it was 7,500. This year it's 8,000. So in total, if you do the 24,500 plus the 8,000, we're now up to 32,500 catch-up.
Meaningful.
Right? So quite a bit. But the difference now is if your W-2 wage is over 150,000, you are no longer able to do that catch-up contribution pre-tax or traditional, meaning you will not get the tax deduction. All of these catch-up contributions for anyone whose W-2 wage is over 150, it has to be Roth now, right? And that's a pretty significant change, especially because this, for the most part, when you're in your 50s, you're in your peak earning years, you really want to be making traditional contributions because you don't have as much time for your Roth accounts to grow and get that tax arbitrage. And you're in a higher tax bracket than you will be in retirement for the most part. So this is a significant change that in most instances is worse off for savers. So I just want to make people aware that if you're, been just doing business as usual and you're not paying attention too much, that it is a big change. So if you're doing your catch-up contribution and it's all been pre-tax, you will need to change that this year if your W-2 wage is over 150.
Yeah, it's a big deal. And I want to bring this in too, because we just talked about this earlier this week with a real life client, newer client that came on board with us. We were in our mastermind group talking about this and just how impactful this can be in real life of how, which both pre-tax or Roth. We were, again, reviewing this with this client. They make quite a bit of money, like high 6 figures. And they had been doing Roth contributions up to this point. And the answer as to why was just I'm just always in Roth. I just like Roth. But as we ran the numbers and we were talking about it as a team, it was something to the tune of $18,000 to $20,000 difference in tax savings in, again, highest income years, mid-career dentist. So I just wanted to highlight that of how critical this
with this, because they'd only been doing Roth, they had so much money Roth, their tax bracket in retirement was going to be, so small, right? Yep. It was even more significant in this case.
Huge. Because to your point, Taylor, I think dentists often just assume, which is totally fair. Dentists often assume because my lifestyle is going to be the same in retirement, which is true, that they assume that that means my income is the same as well and my tax situation is the same, which is not true.
Yep.
And that location of your assets is so critical of where you're putting those assets, and thinking not only year to year. This is why we often battle sometimes with some CPAs, because we're thinking long-term planning and thinking about the lifetime tax consequences. To your point, if you've piled up a bunch of money in Roth, that has a massive, massive impact of where your tax bracket's going to be in retirement. We've got to think about that over a 10, 15, 20, 30-year period, not just year to year. So I'm glad you brought that up. We went a little side quest there, but I think it's really important for dentists to be thinking about this. It's a pretty big consequential decision over time, depending on your income. And if you're not thinking about it, you need to be, or have someone in your corner thinking about this around pre-tax versus Roth. It's a really, really big choice.
Yeah. And another caveat I want to make on this is it is important to note that this is based on your W-2 wages. So this is actually Social Security wages, box 3 of your W-2, right? And so for S Corps, which the vast majority of our business owners listening are going to be this case when it comes to their taxes. With S Corp, you're going to split your income into 2 boxes. You're going to split your income into W-2 wage and then business distributions, right? So business distributions are excluded from this, right? So it's not AGI, it's not business distributions, it's just
salary
W-2 wages. And so if you are a practice owner, right, and you have your spouse on payroll, which a lot of people do, right? Your spouse, assuming their W-2 wages are not over 150, they can still qualify to make a pre-tax catch-up contribution, right? And that's going to be actually beneficial for a lot of our clients, where they are, a lot of people, practice owner, non-working spouse, and they have both spouses on payroll, right? So they can max out the 401ks. Well, if the dentist is over 150, they have to do Roth, but they can still get that traditional contribution through their spouse that may just be making 40,000 to max out that 32,500 contribution plus catch up.
Yeah. I'm just really glad this added another wrinkle and something for dentists to be thinking about when it comes to setting your salary. You've got, we've talked about this before, you've got QBI balancing it with FICA taxes. Now you've got your W-2 salary as a business owner. You've got to balance out, the catch-up contribution. We're going to need a matrix here pretty soon.
It's funny because I was reading about it. If you happen to not be an S Corp and you're sole proprietor, well, then technically your self-employment wages are not W-2, so you're actually not subject to the Roth mandate. So you can make more than the 150 if you are a sole proprietor.
Yeah, you're not taxing yourself as an S Corp.
Yeah, which there are certain businesses, especially in the first couple of years of being a business owner, where that might be the case, right?
You're definitely. Yeah, so, you probably should be early on, yeah.
If this confused you, don't feel bad. It confuses us too. But please.
That's why we're here.
It's just a reminder to reach out to your CPA, your financial advisor, right? Make sure you're coordinating your retirement contributions. You're doing it correctly. And then just one more little wrinkle. This year, there's what's called the enhanced catch-up contribution for anyone ages 60 to 63. So again, anyone over the age of 50 has the 8,000 catch-up contribution. But if you are between ages 60 and 63, you can do another 3,250, which gives your total catch-up contribution a total of $11,250 that you can do.
So random those
ages. More random.
Yeah.
Completely random and arbitrary. So
if you fit in that window of 60 to 63, you can do even more. Okay. Awesome. Rabih,
you ready to waterfall that back to us?
We're going to cascade that back, Rabih, real quick.
I'm so glad that you guys are experts on that subject where I don't have to have any input. I'm so glad.
Whenever Rabih calls us an expert, I just get a little tingle, I just get I get a little goosebumps. Always makes me feel good. No, that's a good summary. And again, it's just a good reminder. There's so many different things to be thinking about. It can be overwhelming for sure. That's not our goal to overwhelm anybody. It's just to be thinking, these are things these are the jobs to be done, as we say. These are the jobs to be done, things to be thinking about from a planning perspective. The tactical things that come from planning, and very, very much critical to have someone in your corner to be thinking about this stuff. Speaking of that, speaking of things that have been coming up lately that I wanted to talk about, we'll call it the investment tip of the week. Just made that up on the spot. So rebalancing a portfolio. This has actually been coming up quite a bit. I've had several conversations over the last probably couple of months. This comes up a lot from dentists of like, when should I be thinking about exiting? Like actual strategic moves or thoughts around exiting, not only from my practice and like things that all come from that, but like investing and like withdrawal strategies and rebalancing and all this kind of stuff. The answer to that, I'd say, is 5 to 7 years out. Like you need to be thinking about it far sooner than you think. One of the biggest mistakes we see is dentists are all of a sudden like, I want to retire next year. It's like, well, you should have been thinking about this 5 to 7 years ago. So this has been coming up a lot around specifically rebalancing portfolios and reallocating portfolios. So quick, just overview when we talk about asset allocation, fancy word for just saying, what is the mix of stocks and bonds in a portfolio? And generally speaking, there's a huge factor here being time horizon. How long are you going to use this money? It's going to kind of influence that. Stocks, the growth, but higher risk. Bonds being more stable, but not going to grow as much. So I've been getting a lot of questions from clients around, should I be rebalancing my portfolio right now because I'm, again, 3 to 5 years out from retirement? And so I wanted to highlight this, and I'm so glad that we have Taylor here to explain to Rabih how this works around rebalancing. But this topic came up. So all of these clients here brought this up, all have automatic drafts going into their portfolio, like pretty significant sums of money going into their portfolio, into like a brokerage account. So pretty much all of them that I've talked to, we've talked about the difference between static rebalancing versus what we call like dynamic rebalancing. So static rebalancing being, I've got 80% of my portfolio in stock, 20% in bonds. I'm going to sell a portion of my stocks and I'm going to buy more bonds. Now I'm going to be 70% stock and 30% bonds. That's static. That's making an actual shift of your allocation. What a lot of dentists don't think about is this idea of, I've got new drafts every single month coming into my account. As opposed to selling and creating a taxable event, what if we just started shifting the new cash coming into the portfolio? It's been going into equities at this point. Let's just start bolstering and adding more fixed income. And then by the time you get to retirement, we ran all the numbers and we actually looked at it. We said, by the time you get to retirement, if you go at this rate, you'll actually be at your 70-30 or your 60-40 or whatever, and you didn't sell anything. So I just wanted to highlight that. I want to get your guys' thoughts if this is coming up, and Rabih, you can add more color or detail to this at all.
Well, I love the thought, Matt. And I think the other thing is, like, I just think you need to be thinking about it, like you said, several years in advance. So you have a plan, because the other plan can be, as we mentioned on, we talked about this on Wednesday, is a lot of people in this situation are also going to have a dental practice that they're selling, and they're going to have a major liquidity event with, hundreds of thousands, if not millions of dollars to invest once they cash out on their practice. And at that point, you could stay aggressively in equities and then buy bonds with the influx of cash that you have coming in from the practice. Yep. So that could come, depending on your situation, it can come from monthly drafts that you're doing over a several year period. It can come from a large windfall that you get from practice and or inheritance, which also tends to happen in your 60s for people with their aged parents, passing away at that time. So there's a lot of different ways other than selling out your portfolio, your equities positions, and moving them to bonds.
Yeah, and to your point, Tara, that's probably the worst case scenario, is that you would do that because it's going to cause taxable gains, and if it's a brokerage account and all that. So, Rabih, let's get you in here. I know you're itching.
Yeah, I am itching. And actually, I like what Taylor mentioned, because dentists are very lucky that they have a practice sale at the end of their career that will bring that money inflow, because for non-dentists, it's probably going to be a very small paycheck compared to a big portfolio that won't make a dent, right? So in the circumstance of dentists, it is more tax efficient just because you're going to be getting money elsewhere. But I also want to highlight something that Matt talked about, which is like, why do we have to rebalance the portfolio to start with as we are approaching retirement? And it is because there is a risk. Like we say, stocks are risky, bonds are risky, but once you're in retirement, it's a new set of risk. And this biggest risk is called sequence of return risk, if you want to Google it. But what it means is that two people, same amount in the portfolio, same amount of monthly needs, for example. If the first person experienced a 30, 40, 50% stock market crash in their first year of retirement, they're going to be worse off than the other person who experienced the same exact crash probably 10 years into their retirement. So when the crash happens in your retirement journey, is detrimental for how long your portfolio can survive. So what we do at Dentist Advisors, we're more systematic about it. What allocation you're going to be in will depend on how much money you need. We figure out how much money you need. We figure out what that translates to in terms of allocation, and we figure out how far in advance do we need to start planning to get to that allocation. And it's a lot of numbers. You don't have to do it. Like, just, ask us. We'll do it for you. We do it for all of our clients who are retiring. But at that point, on one hand, you make sure you're transitioning correctly to the right allocation so your portfolio can last hopefully forever. And on the other hand, you are eliminating those new risks that are showing up, such as the sequence of return risk. So it is more nuanced than just, oh, I'm retiring, now I'm going to go into a 60-40. There are more layers to optimize it. But in general, it is better than doing nothing as you approach retirement.
Yeah. And I think the theme of this is just highlighting the things to be thinking about here as you're, no matter what stage you're at, as Taylor, you highlighted earlier, a mid-career dentist thinking about pre-tax versus Roth and the implications that can have over time. But then as a later stage dentist, the decisions that need to be made just in the investment portfolio, things to be thinking about there of like the things, the reallocation and the rebalancing strategy and how that's going to impact the withdrawal strategy. There's just so much there that we want to highlight that you want to be thinking about. And again, earlier than you think. I think that's the biggest takeaway here, thinking about these things earlier than you think. So hopefully that's helpful. We wanted to kind of bring more real world example here of tactics and strategies on the investment side. Anything you guys want to add, Taylor? Anything else you have? You want to cascade back anything?
No, I keep thinking, like, I even took like a personal finance class in college. And I remember the professor being like, your age in bonds, you can do this all yourself. Just make sure you always have your age in bonds. And that's why I was laughing. I was just thinking, like, how
no
simplified, but that's like a really common thing that people use, that do this themselves. It's just, just keep your age in bonds and that's all you need. And it's like,
sure,
you can, but you're missing out on a lot doing it that way.
I would say we did annual reviews with all of our clients near the end of this past year. And if you would have told, if our clients, let's say 45 or 50-year-old clients, were following that, I'm not kidding you. We did a review. We always review the investment portfolio allocation, returns, all of that. Obviously, numbers look amazing right now, but that advice right there alone in this last 3-year run would have costed an accumulation of millions and millions and millions of dollars to our clients if we would have just followed that guideline. So this fits the theme, Taylor. General advice is not good specific advice. That's a really good example. Rabih, any other words of wisdom?
Nope. If all I'm gonna say is, like, I'm trying to summarize all the things you need to do so you can give it as a general advice, and it's like too much. So probably just have a buddy alongside to just walk you through it. That would be better.
Get some help. We all need help. We all need a buddy. This is awesome, guys. Really fun to be back. Taylor, fun to have you back. I'm really happy to be back. I'm saying
so
back.
happy both of you are back. I need to put it out there.
Yeah, it feels good. A couple of things we want to highlight. We have 2 big things coming up that we would be remiss if we did not mention. Number one, if you're listening to this at the end of January, early February, it is not too late to sign up for Launchpad. It is starting February 6th. You have a final week to sign up. We are so excited to do this. 12-week live courses, also on demand. Going to be teaching you everything that you were not taught about money in dental school. First cohort, 50% off. We highly recommend you check it out if you are in that kind of D4 new grad range and you want to learn about things that we talk about on the show all the time. I would highly recommend it. So you can go to dentistadvisors.com/launchpad. And then also want to mention the summit coming up this year. Super excited. 3rd annual summit. Changing locations this year. Still amazing content. The theme this year is practice on your terms. Really, really excited for that. So check that out at dentistmoneysummit.com. We'd love to have you out in June. Come hang out with the team. So for now, Taylor, Rabih, thanks for being here and sharing your words of wisdom. Everyone, thanks for listening. That was our 2 cents. Till next time. Bye-bye.